The panic has subsided after several of America's largest banks were closed this year. And in many ways, things are getting back to what you might call normal. Before we begin, remember to like this video and subscribe for more economic updates. It's interesting to note that according to a new report issued by the Federal Deposit Insurance Corporation, or FDIC, U.S. banks lost a record number of deposits in the first 3 months of 2023. From January through March, a total of $472 billion was withdrawn by depositors from America's banks. That represents an overall decline in deposits of 2.5%, the single biggest quarterly drop since the FDIC began collecting the data in 1984. The first quarter of 2023 also marked the fourth straight quarter of overall deposit outflows from U.S. banks. In a way, the big total of withdrawals makes sense when you find out that most of the money withdrawn represents uninsured deposits, which means funds in excess of $250,000 per account per bank limit covered by the FDIC. Uninsured depositors actually took a total of $663 billion from banks in the first quarter. So why were net withdrawals only $472 billion? The answer is partly because insured deposits actually grew by $255 billion in the first quarter. Keep in mind, that all happened before one of the 3 recently failed banks went under. All 3 failures happened from the middle of March through the beginning of May. They were 3 of the 4 largest bank failures in U.S. history. But only 2 of those failures, Silicon Valley Bank and Signature Bank, are reflected in the new FDIC report for the first quarter. Each of those institutions fell just days apart during the month of March. The third bank, First Republic, collapsed on May 1st. As a result, FDIC Chair Martin Gruenberg acknowledged that the first quarter report may be an incomplete assessment of the recent banking system fallout. He told reporters that the more lasting effects of the industry's response to the stress may not become fully apparent until we receive the second quarter results. Here's something else interesting. The FDIC's report also discloses that the number of banks on the FDIC's problem list rose from 4 to 43 during the first quarter. It's hard to find anything good in all this news, but over the past 2.5 months, Americans have been reassured repeatedly by the nation's top financial regulators, including Treasury Secretary Janet Yellen and Fed Chair Jerome Powell, that the banking system remains sound. And it is important to note that since the creation of the FDIC in 1933, no one has ever lost a penny of insured deposits. FDIC Chair Martin Gruenberg talked with reporters about both the good news and the bad. On the one hand, he said, the banking industry has proven to be resilient in the face of recent challenges, but he also emphasized that banking continues to face significant downside risks from the effect of inflation, rising market interest rates, slower economic growth, and geopolitical uncertainty. We'll keep you posted on this story as it develops. Until next time.